This is Forecast Free Friday for May 24th, 2019. My name is Jay Coulter, and my partner in this project is Clint Sorenson, the CIO of Wealth Shield. I want to start off with a story, Clint. About 6 months ago, I was working with an advisor, helping him build out his rules-based model portfolios. When we got to the part where we were talking about fixed income strategies for larger clients, he is a seasoned advisor. He'd been in the business 10 years, was really interested in using ETFs and maybe even mutual funds. And I said, well, why don't you just roll some simple short T-bill ladders? And he looked at me right in the eye and he said, Jay, how do I do that? And I said, do you not know how to execute T-bill trades? He said, no, how do T-bill ladders work? And it occurred to me, it made me feel old, Clint, but that's how in the 90s we got started with client portfolios. It's basic fundamentals of investing, and there's a whole generation that doesn't know how to do it. What are your thoughts on allocating to fixed income for larger households? It's a conundrum now.
Yeah, it really is. And it's so funny in the RA space. Matt Sonnen actually had an article about this on LinkedIn the other day, and I commented on it just about a recent experience we had in terms of, as an OCIO, we had a big client come from a major bank. A lot of fixed income assets because the average household was somewhere between that $2 and $10 million mark. And so there's a lot of fixed income assets. And we really prefer individual fixed income. And we like rolling ladders on the T-bill side on the short term, especially for like corporate cash, right? You can get a lot of yield there. Think about this. Last week, you had the yield curve. So the difference between the 3-month T-bill and the 10-year Treasury note yielding the same thing. They were both yielding 2.4%. So you could go in 3 months, get 2.4% and roll government securities every 3 months or build a ladder of those, right? And you can end up building a pretty nice portfolio with a decent yield backed by the United States government. And I'm not here to argue the credit quality of the United States government, but I can definitely say that it's high. We're most likely the cleanest dirty shirt out there. So I think that's a great way to manage short-term cash. And then I also love municipal bonds for high net worth households. Helps with tax location because, again, the 5 areas of advisor value, which is behavioral coaching or financial planning, asset allocation, security selection, rebalancing, and the last one's tax management, can't be ignored. And that tax management piece, you can do a lot of great things by doing tax location, allocating to municipal bonds for larger households. There's a lot of ways that help with that after-tax yield to the end client. And so that's typically the way we prefer to manage fixed income. Smaller households, a little different, right? And then I think there's this new thing called bullet shares, which I really like. It's relatively new, where you can allocate to specific maturity ETFs or baskets of underlying bonds and target maturity. So you can actually build ladders with these bullet shares. So tend to like that on the smaller household levels. High net worth households, we like the individual fixed income.
Yeah, I worked for Guggenheim when they rolled out those bullet share products. And the real key for advisors looking at it is don't pay attention to the current year and be very careful with the next year because there's some mechanisms inside there you need to understand. But outside of that, gosh, Clint, for almost a decade now, they've performed. They're a viable tool to capture that yield.
That's right. And again, I still prefer the individual bonds. Maybe I'm a little old-fashioned, but I think there's a lot of value to be added there. And then think about behaviorally from an aesthetic or optics standpoint for the end client, right? They're not seeing one ticker that has an index of underlying bonds. They have each underlying issue. And for some clients that we talk about this a lot, the aversion to ambiguity, right? They like what's familiar, what they recognize. So in a corporate bond ladder, you can allocate to corporations that they recognize or that they're comfortable, that have high credit quality, same way you would build a stock portfolio. And in the municipal space, right, they understand a lot of these underlying projects if they're active in their community. And so I think it's a great way to align a portfolio with a person's behavioral bias, right, or their aversion to ambiguity.
Yeah. So let's wrap with this. And I want to be clear, there's a distinction between a forecast and an informed opinion. What are your thoughts on bond mutual funds?
Yeah, so I think I've got issues with mutual funds in general. Right now, it's hard to add a whole lot of value in the fixed income arena, right? Yields, everything's really directionally responsive to yields. We've seen a lot of unconstrained mutual funds pop up along the way. I don't like those. Personal reason or opinion on why I don't like those is because I feel like those are just a way of removing a benchmark. How am I going to measure and map an unconstrained strategy? So you're really betting on a manager's ability to add alpha, but I can't measure that because I have no idea what their index is. So it's very difficult, other than now, looking at a peer group, to measure how well an unconstrained bond manager does. And those are a lot of the mutual funds in the space. Typical intermediate term bond fund or what have you, then it didn't just becomes down to cost, right? I think there are some advantages because they frankly are probably getting better execution than the individual bond investor. However, you got to ascertain whether that individual bond execution, right, the execution benefit they get or that edge, whether that's going to materialize into a statistically significant gain in outcome. I don't know, right? I don't know. And I think when you look at all the studies and you look at the studies between active management, it carries over to fixed income. It carries over to fixed income as well. It's hard to outperform a well-constructed index, a well-designed index in the fixed income arena. So I'm not a huge personal fan of mutual funds in the bond space, but obviously there are managers out there who have a history of demonstrating a solid process and a process that someone can rely on that's quantitatively based. And if you're willing to pay the extra cost for that shot at getting a little alpha, so be it. No one can measure and tell you what they're going to do in the future.
Well, my concern with the unconstrained bond funds is you don't know what's in there. It's almost, it's a strong word, but it's almost like they're a gimmick. You look inside and they have Cayman Island Trust, where inside there they have 2 in 20 products, and the advisor and clients think they're getting an allocation to a safe fixed income strategy.
That's exactly right. Yeah. I mean, they're buying a bond and they end up getting an alt. And it's right. The same, so same thing in the liquid alt space. I'm not a big liquid alt mutual fund guy because at the end of the day, alternatives give you the premium from the illiquidity. Why am I going to buy a liquid form?
That's right.
So, I'm with you on that. I mean, again, you got to know what's underlying any fund or ETF you're allocating to, and you got to understand the liquidity characteristics, and you got to understand a lot. It's more than just finding a good mutual fund from a good organization and allocating to it.
That's right. All right, Clint. Thanks for another great Forecast Free Friday.